Hi everyone, this is Dr. Diana Songsong. In this lesson, we are going to have some exercises on stocks and bonds. For more detailed lesson regarding those topics, please click on the card above. But if you have already watched that, then you may not proceed with this lesson.
Okay, so here are the formulas that we need to recall. For bonds, the yield is given by I over P, where I is the bond's annual interest and P is the purchase price, how much is the price that you bought for your bond. And then for stocks, the return on investment is your net return on investment over cost of investment. This is in percentage form. Okay, so of course you have to multiply the answer by 100% if you want your answer to be in percent form. And dividend yield is equal to the annual dividend per share over the current stock price per share. Okay, so let's look at some problems. Okay, so for the first one, we have Ken bought 100 shares of a stock for 50,840 pesos. A year later, he sold the stock for 490 pesos and 20 centavos per share and paid the broker 1.5% commission. What net amount did he receive in this sale? Now, take note here that you can immediately see that Ken experienced a loss, right? Because from this 50,840, but this is already 100 shares. So we can see here that one share, he bought one share for 508 pesos and 40 centavos. How did I get that? 50,840 divided by 100. Correct? Okay, but he was able to sell it only for 490 pesos and 20 centavos. But anyway, the question is, what net amount did he receive in the sale? So for letter A, of course, what will we do? The number of shares times the price per share, right? Let's compute that first. Price per share. So 100 shares times 490.20. So he can get, so times 100, that's 49,020 pesos. But he still has to pay the broker 1.5% commission. So what does that mean? From your 49,020 pesos, you still have to subtract 1.5% of that. What is 1.5% of that? 49,020 times 1.5% in decimal form. Don't forget to move two decimal places to the right. So that's times 0.0015. Okay? So when you now use your calculator, so this is the net amount. So that will be equal to 48,946.47. So he actually lost money there. Okay, so for letter B, if he placed 50,840 in a time deposit that pays 3% interest a year, how much money will he get at the end of 1 year? Okay, so again, this is just like we're looking for, what's that? I net, correct? Because we have withholding tax. That's PRT. And then times 80%. Okay? So what is that? My principal is 50,840 times R. So 3%, right? So that's 0.03 times 0.8. So when you use your calculator, you will get 50,060 pesos and 16 centavos. So obviously, for letter C, which one is a better option in this scenario? So the better option is the time deposit, because as we have seen here, he actually encountered a loss when he invested in stocks. All right. Next, a bond with face value 30,000 has a semi-annual coupon rate of 5 years. After 5 years, the bond is sold for 35,000. What is the current yield of the buyer? Okay, let us recall, how do you get the yield or current yield of the buyer? That's I over P, correct? And what is I? I is what is your I there? Your annual interest. Okay? It says here that 30,000 has a semi-annual coupon rate of 5%. What does that mean? How much is the coupon? Coupon is, how much will be the coupon? 30,000, right? You can compute it as follows. 30,000 times 0.05. Okay, but this is semi-annual. So every 6 months. So that's over 2, because there are 2 periods in 1 year. Understand? So how much is that? This is equal to 300 pesos per, this is per 6 months. Okay? So that means, or if you just want the annual interest, you can actually just take out the annual interest is just 30,000 times 0.05. Okay? So that's your face value times the rate, annual rate. Understand? So that is 600 pesos. But if you want to get the semi-annual, so this means 600 pesos annual interest, but every 6 months you will get 300 pesos. Understand? Okay, so the point is, what we want in our formula is the annual interest. So the annual interest is 600. But what is our P class? This is the purchase price of the buyer. What is our P class? In this case, purchase price of the buyer. And since we are asked current yield of the buyer will buy the bond at how much? Is it 30,000 or 35,000? The answer is 35,000, correct? So that's it. So 600 over 35,000. So that is 3 over 70 in percent form. That's approximately 4.29%. Okay? Next. Suppose a share of stock originally cost 750 pesos. After 2 years, the current price is 900 pesos. What is the total stock return on investment if it pays an annual dividend of 50 pesos per share? Now, let us recall, how do we get the return on investment? What is our formula? That is net return over the cost, right? Okay, how much return did you get in one share? Let's just take a look at one share. So first, you bought it for 750 pesos, but now you were able to sell it for 900 pesos. So there you have a return of 900 minus 750. But what else? You have a dividend of 50 pesos annual. That's annual dividend. But since you held it for 2 years, okay? So how much dividend did you get? 50 pesos. That's annual. So times 2. Okay, because you held your, you had you had your dividend for 2 years, all right, over cost. What is the cost? The cost when you bought the share. So what is that? That is 750. Okay, so that's 150 plus 100 over 750. So we get 250 over 750. So that's 1/3, or approximately 1/3. That is 33.33%. Okay. So for our next example, Anna bought 1,000 shares of a stock LCC on January 15 at 15 pesos. On June 1 of the same year, she sold these shares at 18 pesos and 50 centavos. How much was her total cash out in buying the 1,000 shares if the broker's commission, transaction fees, and taxes total 0.25%? Now, what is the meaning, class, of the word cash out? This is the cash that she gave when she bought the shares. Okay, so what are we looking for here? She bought 1,000 shares at 15 pesos. So this is when she bought it. So buy 1,000 shares times 15 pesos. So that's 15,000. Right? But we still have to add the broker's commission, transaction fees, and taxes, which total 0.25% of this. So meaning to say, we still have to add 0.25% of 15,000. So that's 0.0025. Okay, and what is that? 15,000 times 0.0025, we get 37 pesos and 50 centavos. So what is this? This is the broker's commission and so on. Okay, so therefore her total cash out is equal to 15,000 37.50. Understand? Next, Mary invested in stocks, and her portfolio shows the following investments. Suppose that the current price, so this price per share here refers to the price when she bought the shares in this company, and then you now have a current price. Without considering the fees she has to pay for selling all her shares in the company, how much is her gain or loss? Okay, so assuming we do not have any broker's fee, etc., etc. Okay, so let us now compute that.
Okay, so I have here an Excel file. So it will be easier if we use Excel instead of using our calculator. So first, let us find the how much did she pay in order to buy this shares. So it's equal to the number of shares times the buying price, and then I will just drag that.
Thank you for watching my video.
Get the sum.
Don't forget to subscribe to my channel and
Equals
also watch for more videos
sum.
here.
So this means she spent 717,740 pesos. And then how much did she sell these shares? So it's equal to the number of shares times the selling price. Drag that. And then for the sum, I will just copy the formula of this. So I will just drag. So therefore, how much is her gain? It's the difference between the selling price, how much she was able to sell all of her shares, minus how much she paid for this share. So this one is the answer. Her gain is 19,230.
Okay, so for our next problem, we have a bond problem again here. Georgina bought a bond with the following details. Par value or face value, that's 500,000. Coupon rate is 7% per annum. Payment is every quarter. Issue date is November 12, 2018 with a maturity date on 2025. How much coupon will she receive and how often will she receive it? So, what is that? How do you get the coupon? It's just the par value or face value times the rate, correct? But you divide it by the number of periods. This is quarterly over 4. So this is every quarter. Okay? So that's 500,000 times the rate, which is 0.07. But then every quarter, so that's over 4. And when you use your calculator, you will get 8,750. Alright, so for our next problem, we still have the same given. It's just that what happens here, she doesn't want to hold the bond until 2025. So she sold it on November 12. But on November 12, the prevailing interest is 4%. Okay, compounded quarterly. Will she be selling the bond at par, discount, or premium? Now, in order to answer this, let's first take a look at the following. Alright, class, the nice thing about bonds is that it gives you fixed interest during the duration of the bond. So, for example, the bond is giving you, let's say, 5% interest. But the current interest now, let's say the current interest is equal to 7%. So the interest rates from 5% to 7%, so there is an increase in interest, right? So if you are a buyer of the bond, will this bond be attractive to you? This is for the bond, 5% interest. Will the bond which gives you 5% interest be attractive to you? No, right? So if it's not attractive to you, that means that there will be a low demand. If there is a low demand, then from economics, what will happen to the price? This will result in lower price. Alright, so that it will be attractive to the people who will buy it. Okay, so that means that if you have increase in interest, this one, you will have low price. So conversely, if the current interest it's now lower than the interest of the bond, let's say this is only 2%, will this bond here be attractive to you? Yes, it will be attractive to you because you will get 5% of your investment, right? So that means if you have fall in interest, then you will have higher demand, and if you have higher demand, then it will result in higher price, correct? So that means fall in interest will result in high price. Here are my key takeaways. Again, remember, if the rate of interests fall, then the price of the bond will increase, and if the interest rates increase, then the price of the bond will decrease. Okay, so actually now in our economy, I don't know what is happening. I think the interest rates are the interest rates are falling, right? after the pandemic, the interest rates are falling. So that means that the price of the bonds will increase. Okay, so if you are a seller, it will be a nice time to sell your bonds. But if you're a buyer, I will not do that because the price are higher. But if the interest rates increase, then this means the price decrease. So if you're a buyer, I will buy because the prices are low. But if you're the seller, don't. Okay, do not sell. All right. Okay, now my point here is that in this case, we have a coupon rate which is 7% per annum. Alright? And then, but now, the prevailing interest is 4% compounded quarterly. Okay, so what will happen there? If you have this bond here is giving you 7% interest. But when she sells the bond, okay, and the current rate is 4%, what will happen, class? This means that rates decreased. Okay, from 7%, the current now is, the nice thing about bonds is that it's fixed, all right? So when they say this is 7%, even if the economy rise, or even if the interest rates, the prevailing interest rates increase or decrease, they still have to give this 7% interest. Okay, but the current interest is it fell to 4%. So what will happen to the price of the bond? What will happen to the price of the bond? It will increase, right? Because this one will look attractive, 7% as compared with 4%. All right? So the price will increase, therefore the bond will be able to sell at a premium. Okay? Next. Same data, but what we have is we're looking for the yield of the buyer. How do we get the yield of the buyer? Yield of the buyer is I over P, correct? So that's I is the annual interest. So that's 500,000 times 0.07 over, what is your P? P is the purchase price of the buyer. So what is that? 500,000 or 600,000? It is 600,000. Okay. So what is now the answer there? So that's 500,000 times 0.07 divided by 600,000. So that will give us 7 over 120, or approximately 5.83%.
Thank you for watching my video. Don't forget to subscribe to my channel and also watch for more videos here.